Okay, class, this video is going to be a video talking about going over some practice problems from like our first homework assignment. I'll probably doing this for every single homework assignment. If you look here, I've created a learning module 1 practice problems. This is not graded. You can take these practice problems as many times as you want. I'll leave them open. You can use this to help study for the midterm as well. And of course, you can review these videos to show how to solve each problem. I'll also have it to where you can, it will show you how to solve the problem as well in the assignment. So really quickly, we're going to open it up. And I'm going to start with the first problem. And we're just going to go over each of these problems and how to solve them. And again, these are extremely similar, if not almost identical to the problems that are on your homework, and be very similar to the problems that will be on your midterm. So the first thing we're going to look at is the cost concept. And again, the cost concept talks about what is the actual price or monetary value you use to record the purchase of an asset. In this example, is talking about the purchase of land, similar to what we talked about in class. So sometimes when you go to purchase a large asset such as land, you're going to have many different monetary values that are going to be available to you. You're going to have the original listing price, which here was $388,500. Then you're going to have in front of you what the initial offer was by the purchaser. So Clementine Repair Service extended an original offer of $350,500. But Clementine Service Repair accepted the seller's counteroffer of $369,500. And then they had the land valued for tax purposes, and the value of the land for tax purposes was $316,700. And then in December, it looks like Clementine was offered $401,200 by a national retail chain to want to buy the land. So when you have all these numbers floating around, you as the accountant have to determine what value do I use to actually record the purchase of the land on the books. So in this situation, it's always going to be the purchase price, the price that was actually agreed upon between the buyer and the seller. So the price that was agreed upon between the buyer and the seller was $369,500. That is the actual purchase price. That is the actual cost of the land, and that's what you record. So again, under the cost concept, amounts are initially recorded in the accounting records at their cost. So under the cost concept, the land will be recorded at the actual cost to the Clementine Repair Service, which is again $369,500. So let's move on to the next one. Here we're talking about the accounting equation. If you remember correctly, the accounting equation is assets equal liabilities plus owner's equity. So like in any simple algebraic equation, if you have two values and you're looking for the value of X, then you rearrange the accounting equation to be able to solve for X. Here you have the value of assets and you have the value of liability, but you don't have the value of owner equity. So you basically just flip around the equation. If assets equal liabilities plus owner's equity, then owner's equity equals assets less liabilities. So in this situation, it looks right here, it tells you how to solve it. So if assets equals liabilities plus owner's equity, right? Then we basically just flip it around and we subtract out, making owner's equity equals assets less liabilities. So owner's equity is $288,000. So we're basically solving for X here. Very simple algebraic equation. Now let's look at B. B is the next year. And what they tell you is that assets decreased by 63,000 and liabilities increased by 35,000. So the first thing you have to do is you can do it one of two ways. You can take the 382 and subtract 63,000, 382 and subtract the 63,000, and then take the 94 and add the 35, or you can plug it in. You can plug in the 63 as a negative and the 35,000 as a positive to get the difference. And the difference was a negative 98,000. And you subtract the negative 98,000. Well, you subtract 98,000 from the 288 from A, and then that gives you 190. So there's two different ways you could solve it. Both ways are completely acceptable. It's just whichever way works best for how your brain views the equation. All right, so in this one, we are basically looking at different types of transactions. Now, again, a transaction is any business activity that affects the accounting equation, okay? So in each one of these transactions, we are determined how is it affecting the accounting equation. So the element is what element of the accounting equation is affected. Item is which item under that element is being affected, and is it being increased or decreased. So I gave us the first one to kind of show this example. It says that cross-country delivery service received cash from owner as an additional investment. Okay, so if they received cash as an investment, so obviously assets and owner's equity is being affected, cash and capital, and they're both being increased. All right, so let's look at the next one. The next one is saying that it paid an advertising expense. So the first thing we're going to look at is like, okay, it's an expense. Expense we know affects owner's equity. So we're going to select owner's equity. It's not being paid on account. Okay, so it's not affecting liability. It's affecting owner equity. And since it's not being paid on account and it's not affecting liability, then it is going to be affecting asset. All right. So now if it affects owner's equity and it's an expense, then we're going to record it as an advertising expense. That's the item under the equity that's being affected. And if we're not paying it on account and we're paying it with cash, then cash is what's being affected. Now, this is outflow of cash. So we're decreasing our cash and we're decreasing our owner's equity. Let's look at the next one. Purchase supplies on account. Well, here it tells us we're purchased it on account. So obviously we're going to affect liability. And we're also going to affect assets because we're purchasing supplies. So we'll switch this around. So if we're affecting assets and we're affecting liabilities, what items are we affecting? So first thing we're doing is we purchase supplies. So the asset that is being affected is supplies, and the liability that's being affected is accounts payable. And we're increasing both. We're increasing our asset because we're increasing our supply, and we are creating debt. So we're increasing a liability. Okay, so we build customers for delivery service on account. Okay, so we build some customers for delivery service on account. So again, meaning we provided a service and we're allowing the customer to pay us at a later date. So what we're affecting here is assets and owner's equity again. So we have asset and we have owner equity. Okay, so why is it affecting asset and owner equity? So first of all, if we are providing a service and allowing them to pay us at a later date, okay, then we are creating an accounts receivable. Money that we know we are going to receive at a later date. Accounts receivable is an asset. How are we affecting owner's equity? Well, if you remember, we discussed briefly in class that when you provide a service, you're able to record that revenue. Even though you haven't been paid for it yet, you've provided the service. So then you have the right to go ahead and record that revenue because you've earned it. You've earned that revenue. So you are able to record it, and revenue affects owner's equity. Of course, it's not showing it. This is something that I find interesting when it comes to Cengage. Sometimes it's a matter of which one do I record first? So if we're looking here, revenue directly affects owner's equity. This is a service that was provided. So the type of revenue that we will record is service fees. Right. So again, we have we've affected our asset by creating a receivable, and we've affected our owner's equity by recording revenue, specifically service fees. And what are we doing with both of them? We're actually increasing both of them. We've increased our assets by creating a receivable, and we've increased our revenue by recording it to our service fees. All right, last one, received cash from customers on account. So if we look at number 4, remember we provided a service and allowed them to put it on account. Well, now we've received a partial payment. Okay, so if we receive payment in cash, that's an asset. If we allow them to pay it, put it on account and then pay us at a later date, well, they're paying off that debt to us. Okay, so they're actually going to be affecting accounts receivable, which is also an asset. So here in this situation, they paid us in cash. So this asset that we're affecting is cash, and this asset we're affecting is accounts receivable. Okay, and this is a situation where we're just transferring from one asset to another. So we're going to be decreasing our accounts receivable that we created up here. We're decreasing it by this amount, and we are recording it as cash. So we're increasing our cash. So again, in this situation, this customer right here that we provided the service for an account has paid us. It's a partial payment, but they paid us. They paid us in cash. So we reduce the receivable that we created for them here. We reduce the receivable, and we basically increase our cash. So we're just moving it from one asset to the next. So it's just a transfer from assets. Okay, so let's check our work. So again, this last problem is an exchange of assets, and this occurs in this situation, resulting in one asset increasing and the other asset decreasing. All right, let's move on to the next problem. Okay, so this problem is a blank sheet problem. And let me show you a quick trick. First, you come over here and you select this, and then you click on each tab. And what it does is it shows everything all at once. I like doing it that way. It makes it so much easier instead of having to click between tabs. All right, so now on this blank sheet problem, what we're doing is we're actually creating an income statement. So really quickly, what is an income statement? An income statement is a financial statement report that shows your revenues and your expenses and the difference between the two, hopefully resulting in a net profit if you have more revenue than expenses, or showing a net loss if your expenses exceeded your revenue, whatever in that time period. So this is the revenues and expenses for up in the air travel services, and it's for the entire year, which ended for them April 30th. So it's saying complete a income statement for the year. So first thing, it shows fees earned. Okay, fees earned, that's your revenue, because if you remember correctly, if it's a service company, then the type of revenue that you record for a service company is fees earned. And then you have 3 different expenses. Normally on an income statement, you record your expenses starting with the greatest value to the least value. And if you look down here, it also gives you all the labels that you're going to use to label your income statement. So this is a little trick that I do. We're going to start with our labels. So the first label here is the label that comes under the income statement. This is going to give you your time period. Okay, so first thing you do is I copy and paste. It cuts down time, and it makes it easier. So the first thing you do is you put in your label, all right, showing the time period that this report is for. And this is telling us it's for the year, which ended in April 30th. All right. Next, you do is the first thing you always start out with is you start out with your revenues. Okay, we only have one revenue. So it says here, if you click on it, it tells you a hint. It says, hey, I want an account name here. So we're going to come up here and we're going to find our fees earned. And we're going to copy and paste our fees earned into this. All right. What was the value of our fees earned? It was $742,000. That was total fees earned. So we come over here and we click it into the cell. Okay. Now, the next thing is it says, hey, we have another label. If you look right here, it says, oh, another label. Well, we're now going to record our expenses. Okay. So we have more than one expense. So we're going to start out with a label saying, hey, now we're going to do all our expenses. All right. Now, again, we always start out with the one that has the largest dollar value, which is that's going to be our wages. Right. And our wages was 470,000. Our next one is going to be our office expenses. And that was 305,000. And then last, miscellaneous expense. And that was for $10,000. All right, so first thing we want to do is we're going to total up all of our expenses. So we're going to get our total expenses. If you look here, it's already put a line down here for us to show us that we're going to total up our expenses. So we just basically add up all of our expenses and plug that in. 785,000. So the first thing I want us to examine is I want us to look at, are our expenses greater than our revenue? If your expenses exceed your revenue, then you record a net loss. If your revenue exceeded your expenses, and you record a net income. So right now we're going to record it as a net loss. All right. Now, net losses should be a negative. So you will put in a negative sign and then add in the value. And if we did everything right, it should be correct. Now I want y'all to notice what I just did. I didn't type the parentheses around the 43,000. I did just put in a negative sign, and Cengage will put the parentheses in for you. So if you get stuck on a problem and you know it's a negative and you typed parentheses around it and it's still showing you got it wrong, delete the parentheses and just put a negative sign in front of the value and then check your work, and hopefully it should correct that issue. Cengage can be a bit finicky about that sort of thing. So just use a minus sign when you know it's a negative. Cengage will put the parentheses around it for you. But that is our first income statement. All right, let's move on to the next problem. Now we're going to do another income statement. We're going to get some more practice doing income statements, but this one's a little bit easier because you're not really having to copy and paste and type it in. It gives you a drop-down menu. All right, so again, it gives us the revenues and expenses of Zenith Travel Services. It's already provided the labels for us, so we don't have to put any labels in, but it is going to ask us to fill in these blanks. So the first thing we do is we always start with our revenues, correct? So our revenues is fees earned, and the value of our revenue was 189,600. So we plug that in. Then it says list your expenses. Again, remember, we always start with our highest and go to our lowest. Our highest is wages. So we'll put in our wages expense, which is 539,800. Next would be our office expenses, 353,800. Last is our miscellaneous expenses at 14,400. Now, the first thing we're going to do is we're going to tally up all of our expenses and plug that in. And that should equal 422,100. All right, so if we look here, the first thing we're going to do is, did our expenses exceed our revenue, or did our revenue exceed our expenses? In this situation, our revenue exceeded our expenses. So we will have a net income. So all we do here is we just take the difference between our total expenses and our total revenue. And that should be 477,500. We did our math right. Oops. So we did math wrong somewhere. All right, so let's redo our math. Sometimes I don't add very well in my head. So let's try this again. 539,800. I'll use my calculator this time. 353,800 plus 14,400. So I did do my math wrong in my head. So in this situation, it's going to be obviously a net loss because our expenses exceeded our revenue. All right, so let's take the difference. And that's 84,000 is going to be the difference. And it is going to be a net loss. $8,400, not 84,000, 8,400. Now we're going to move on to our owner's statement of owner's equity and how to calculate a statement of owner's equity. All right, so the first thing I'm going to do is I'm going to start out with my labels. So this says prepare a statement of owner's equity for the year ended April 30th. So it's not the month ended, it's the year ended. So you got to make sure you select the right label. And again, you can just copy and paste it down. Makes it so much easier. All right, so we always start out with what the previous capital balance was. All right, so if this is for the year that ended April 30th, 2007-ish, 717, then we want to know what was the capital beginning previous year. So we would take the capital for the previous year, and that's what we start out with. So it tells us up here that Jerome Foley capital as of May 1st, 2006 was 657,000. So that's what we would plug in. Next thing we want to look at is what was the net income for the year? Well, it doesn't tell us. We have to actually calculate that up. So we'll go ahead and determine if it had a net income or a net loss for the year by taking the total revenue of 1,430,000. And I'm going to use my calculator this time. And then subtracting out all the expenses. All right, so it's showing a net income for the year of 191,000. Let's see here. Was there any additional capital? So Joan Foley, the owner, invested an additional 60,000 in the business during the year and withdrew 27,000 for personal use. So we do have an additional investment by the owner for the year of 60,000. And we did have withdrawals of negative 26. So we'll put a negative. Okay. So next we want to determine, was there an increase or decrease in owner's equity? Well, I can already tell you right now it was an increase in owner's equity. So the next label we'll use is what is the actual capital balance now for the year ending April 30th, 2007. So let's go ahead and plug all that in and look at it. So it shows here in the answer that you start out with the previous year's capital. You list additional investments, what the net income for the year was. And again, we had to calculate that up here by taking our total revenue and subtracting out our expenses to determine if we had a net income or a net loss. We had a net income of 191,000. We also would put in the withdrawals that he did. They gave us that information up here in the problem. So we know that that's going to be represented with a negative. We calculate if there was an increase or a decrease in owner's equity for the year. It increased by 224,000, which means we now add that into our previous year's capital, and our new capital balance is 881,000. So here's another statement of owner equity practice problem. So we're going to start out with putting in all the labels, and then we will plug in the numbers and do our calculations. So you always start out with the previous year's capital. All right. And the capital as of September 1st, 2003 was 456,000. Next, any additional investments. And it said here that the Megan Cox invested an additional 43.2. All right. The next thing we had to determine is, was there a net income for the year or a net loss? So let's go up here and do some quick math. We'll take the revenue of 899,600 and subtract out all the expenses, 353,800, so 14,400 and 539. All right, so we had a net loss of 84,000. So we'll put in the net loss and we'll put in the negative 84,000. All right. It also said that she withdrew 21,006 for the year. So we will put in our withdrawals. And we'll put in the 21,600 negative. Now, do we have an increase or a decrease in our owner equity? If we look right here, it's very obvious we had a decrease in owner's equity. So let's go ahead and just plug all that in. So, so we started out with the capital balance for the previous year, plugged in all the variables that changed owner's equity. So this was her, she did an additional investment of 43.2. We had a net loss of 8,400. And we also did withdrawals. So if we look here, it should result in an increase in her owner equity of about 13,200, which did increase her overall capital by 469.2. Next, we're going to do a balance sheet. So again, I'd like to click on all the tabs at the top so we can kind of see everything all at once. So what we're going to do here is we're going to start out with the labels. So again, your first label is always going to be the time period. And it says here that it is for the year, not the month. The year ended April 30th. So we're going to do the year. All right. First thing you do is you list all of your assets. So we're going to have to do some math. So I'm going to save a little bit of time and I'm going to show the answer key, and we're just going to talk about the answers and how they came up with the answers. All right. So it gave us several accounts and it gave us some account balances. So the first thing we're going to look at is what on here is an asset. So looking at here, your fees earned and your expenses is what shows up on the income statement, not on the balance sheet. So we're coming down here and we have accounts payable. Well, that's a liability. Accounts receivable, that's an asset. Cash, that's an asset. Land, that's an asset. And supplies, that's an asset. If you remember correctly on the balance sheet, the order that you put assets is going to be how liquid they are, how quickly they can turn into cash. So cash is already cash. So that's the first asset you list. If you look down here, that's what they just listed. They did cash first and plugged in the value. Then they put in the accounts receivable. That's the next asset that can be liquidated in cash. Then supplies, and last, land. And once you plug them all in, you want to put in your total assets and add them up. Next thing you list is your liabilities. They only had one liability, and that's in your accounts payable. So you plug in accounts payable and you add the value of the accounts payable. Next is owner's equity. So they don't really tell you owner's equity. You have to calculate that yourself. So how you calculate that you come up here to your expenses and your fees earned, and you basically determine if you have a net income or a net loss. So we add up the 746, subtract out the 295.5, 10.3, and the 450. All right, that actually ended up being a net loss for the year of negative 9,800. Okay, so we have a net loss. All right, so the next thing we're going to do is we're going to look at the information they provided up here. So we got to kind of do some math. So it told us what our initial capital was, which is 390,000. So we're going to take that 390,000 addition of what our previous capital balance was. And we're going to look over here. It says, okay, we had an additional investment of 36,600. So we're going to take 390 and add in the 36,600. All right. We had a net loss of 9,800. So we're going to take the 9,800 and subtract that out. And we also did we also withdrew cash of 16,600. So we're going to take that out. And once we do, it gives us a balance of 400,000, 402,000, 400,200. I'll say that right in a minute. So if we take that 400,200 and add it to the 43,600 that was our accounts payable, it should equal what our total assets equal. And then therefore our balance sheet now equals. We'll do one more problem. This is another practice problem for the balance sheet. The account balances of Zenith Travel Services for the year ended August 31st, 2004. And the accounts and the balances are listed below. All right, so first thing we're going to do is we're going to put in our cash, because that is our most liquid asset. Next, we're going to do our accounts receivable. That's our next most liquid asset. We have supplies. And last, we have land. All right, so what we'll do at first is we'll add up all of our assets. All right, so next we move on to our liabilities. All right, we only have one liability, and that's our accounts payable. And the balance for our accounts payable at the end of the year was 53,500. So next we want to take our capital. All right, so again, we're going to have to calculate what our capital balance is. So first thing we start out with is it does tell us all of our revenue and our expenses for the year. So we have to calculate out what our net income or net loss was. So we start out with $899,600 as our revenue. And we subtract out our expenses. I don't know if you've noticed a pattern, but in some of these problems, they are a continuation of each other. So this gave us a net loss of 8,400. We have a net loss of 8,400. We're going to plug that in with the information we have down here. So our previous capital balance was 456,000. We had an additional investment of 43,200, so we'll add that in. We did do a withdrawal for cash of 21,600, so we will subtract that out. And then we did have a net loss of 8,400. And we'll also subtract that out. So our new capital balance should be 469.2. So if we did our math right, we should be able to take that 469.2, add in the liability balance of 53,500, and it should equal our asset balance of 522,700. So we'll check our work. There we go. Last is we're going to do a statement of cash flow. All right, in the statement of cash flow, the only thing that we really care about is your cash. And so we're going to take what the cash balance was and determine what activity did that cash come from and did that cash go. So it's basically you're going to take all the transactions for the whole time period. And for this one, it's going to be for the whole year that ended April 30th, 2007. So we're going to take that, all the cash transactions, and we're going to plug them in and determine if they were an operating activity, a financing activity, or an investment activity. All right, so it does give us some cash flows. It gives us all of our cash receipts, which are inflows of cash. And then it did give us all of our payments that we paid out of cash, which is our outflow of cash. So we just got to determine each one of these, if it was operating, investment, or financing. So first thing we're going to do is we're going to come over here and plug in our labels. So the first label is your time period. All right, and this is for the year that ended April 30th, 2007. So that's our first label. So you always start out with your operating activities. So this is our cash flows from or used for operating activities. So that's going to be our first label. So we come up here, cash received from customers. So that's definitely from operating activities, and that is an inflow of cash. So we're going to start with this one, and that is cash that we received from customers, and it was for 1,469,000. So we'll plug that in right here. All right. So if we look down here, we do have cash paid for operating expenses. So that is definitely an outflow of cash for operating activities, because it tells you right there is for operating expenses. So we're going to take that account and plug that in down here. And that was for 1,217,000. All right, so this is going to be an account description. So we come up here and we're looking for an account description. And this is net cash flow from operating activities. You plug that in. And basically what you're going to do is you're going to obviously take the difference. So you're basically taking the difference. This is your cash inflow and your cash outflow. So you take the difference between the two, and that's total net cash from operating activities. So we'll plug that value in, and that's 252,000. All right, so the next thing we do is we're going to do our investing activities. That is next on the list. So that's our next label we're going to come in here and plug in. So if we look up here, did we have any investments? So this one is going to be confusing because it says investment in the account. But if we remember correctly, when we went over cash flow statements in class, that any investments made by the owner is considered finance, because you are eventually going to, that is not money that is used to, is money being used by the owner to finance his company. So yes, he's investing that money into his company, but he's also using his personal funds to finance his company. So cash received from additional investment from owner is not considered an investment. So this would not be used in the cash used for investment. However, if we look down here, we did purchase land. Well, that is an investment. That is absolutely an investment, because land is an asset and land never depreciates in value. It can only appreciate in value. So even though he purchased land, he could consider that an investment, because it's not being generated, it's not being used right now to generate revenue, but it could be sold in a future date for a profit. So definitely consider that an investment. So he did pay for it. So that's going to be a cash outflow. So we'll put that down here. And 136. All right, the last label we're going to use is for financing activities. So let's do our financing activities. So that is not what they want to put there because it's in red. So let's click on this. It's saying, okay, so again, Cengage can be a little picky. So it's wanting an account description and not cash paid for land. So what we'll use, we'll go over here in account descriptions, and cash paid for purchase of land is what they want. So let's see if that's going to be the correct account description. Okay, yes, it's no longer in red. All right, so now let's go back up here at the top and let's look to see if we had any financing activities. So we talked about this. Yes, it's an investment by the owner, but it's being used to finance his company. So we are going to label this under financing activities. So cash received from owner as an investment. So we'll put that label here. And he invested 49,000. So we'll put 49,000. We do up here for cash payments. We do see that cash paid to owner for personal use. So cash withdrawals for owner will be the account description. And we'll put that in right here. And they withdrew 20,000. So that'll be a negative. All right, so we want to look at net cash flows from financing activities will be the next accounting description. and we will take the difference between the two, which should be 29,000. So let's just go ahead and show work and complete out the rest of the problem. So we do have a net increase of cash. So how you come up with a net increase of cash is you add all these numbers together. So you take the 252, subtract out the 136, add in the 29,000, and you get a net increase in cash of 145,000. All right, if you look up here at the top of the problem, it did tell you that the cash balance as of 2006 was 207,000. So that's what your cash balance was for May. So you're going to plug in the cash balance for the previous period of 207,000. You add in the net cash increase, and that gives you your new cash balance of 352,000 for the year ended April 30th, 2007. So we'll do one more practice problem, and then that will be the end of this recording. So again, we'll just go ahead, and I'm just going to go ahead for time purposes, show the answer key so we can just kind of talk about it. So for operating activities, you are going to go to the drop-down menu, and you're going to select the appropriate account description. So we start out with operating activities. So if you look up here under the cash receipts and the cash payments, all right, you look for anything that's directly related to operating activities. So we have, first one is cash received from customers, which was 181,000. So you would select cash received from customers and plug in the 881,000. Then you would come back up here and you look for any cash payments that were directly related to operating activities. So again, we have cash paid out for operating expenses of 895,000. So we would come here and we select cash paid for operating expenses and plug in the negative 895,000. So next we will then select the net cash flow used for operating activities and do the math. So take the 881, subtract out the 895, and that gave us a net cash flow used of negative 14,000. So we had a negative net cash flow for operating activities. And then we come back up here for cash receipts and cash payments and look for any investing activities. Again, any cash received as an investment by the owner is considered a financing activity, not an investment activity. So we don't have any cash receipts for investing activities. So let's look at cash payments. We did purchase land. Land is considered an investment. So we come down here, cash paid for the purchase of land is what we would select. And we would show it as a negative because it was a cash outflow. So we'd put a negative 60,000. Right. Last is we're going to look at our financing activities. So if we look up here, we did have a cash received from owner as an investment. And again, he's financing his company. So that's considered a financing activity. And he invested 43,200. So we would plug that in. We did see that he did take out 21,600 for personal use. So we would show cash withdrawals by owner. And we would plug in the negative 21,600. And so then the next thing we would do is we would take a net cash flow from financing activities and we would take the difference. And the difference was 21,600. And we had a positive cash flow from financing activities. So then we would need to determine, do we have a net increase or a net decrease in cash? So once we added up all three of these numbers, we showed that we actually had a negative 52,400, which resulted in a net decrease in our cash. So to determine our new cash balance for the year ending in 2004, we would take our cash balance from the previous year, which was 106,900. They gave it to us right here in the problem. All right. We would take that 106,900 and we'd either add or subtract the net change in cash. Here is a net decrease, so we're going to subtract out 52,400. And our new cash balance ending August 31st, 2004 was 54,500. So again, really quickly, if you go into your assignments in Cengage, you will see these practice problems. You are more than welcome to practice these problems as many times as you need. I will leave this open and available for you to review and do on your own. And this will be great practice for the midterm. And I'll be doing this for each homework assignment. If you have any questions or concerns, if you can't figure a problem out, even after doing the show me how to tab and it's just not clicking with you, feel free to send me a quick email, tell me which problem you're having difficulties with, and I'll help you troubleshoot it. Sometimes it's just a matter of Cengage wanting you to put it in a specific order, and maybe you're not putting it in that order Cengage wants you to, or maybe you forgot to use a negative. So hopefully going through these problems, making a few mistakes to show you how to correct them, how you can check your work and be like, oh, I did that wrong. How did I do that wrong? To go back and correct it, check it again, etc. Move on to the next. So again, if you have any questions, any concerns, any problems, feel free to email me and I will help you troubleshoot it. So again, good luck to everyone. I hope this is a great help for you guys.